There is no doubt you're in my heart now.
All right, I think we're ready to get started. Welcome back to the GK Client and Shareholder Review or Overview. It's been a while and I'm back. And we took a 6-month break from doing these shows for various reasons, mostly because of a lack of time. We've been extremely busy over the last 6 months, and you know, I do so much media that a lot of the information that I do in these reviews were actually already being put out by major media organizations. So we decided to do a half-year review to give our clients and the public an overview of where we see markets, the economy today and over the next 6 months to a year into the future, which of course is a forecast, which of course we have no idea what will happen in the future, but we're going to give you some thoughts about that today. And then we'll go into our individual stocks that we hold at our firm, GK, and within our fund. I'm going to use or avoid the use of the 3 letters of the type of fund that we manage because it will cause more compliance. So let's just say that these are the holdings of our firm and the holdings that many, if not most, of our clients have in one way or another. So we'll be reviewing the stock market, the economy, and then our individual holdings. Followed by our show, Let's Talk Money, where we're going to talk a little bit more in detail and take questions about financial planning and the things that affect our clients in building a great future. So here at Gerber Kawasaki, our main goal as a firm is to really improve your financial situation. And as a firm, it starts by building a very solid financial plan, working with a financial advisor to help identify and achieve your goals. And then secondly, through superior investment management, where we actively manage your funds to help get better results for our clients. Now, of course, there's no guarantee that our hard work will ultimately end in getting better results, but one thing is for sure, we certainly try hard to do that. Past performance is not indicative of future results, and we've had a very good run over the last decade. And over my 3-decade career, the stock market has been very kind to me and my clients. So we highly recommend that if you are an investor in GK, that you are a long-term investor and build a solid financial plan. So let's start with the economy and what's happening with the United States. So firstly, we've now entered the second half of 2024. The first half of 2024 was highlighted by very, very strong markets up until the middle of July, which then we saw probably one of our first real corrections for the year. And so through the first 6 months through June, performance in the S&P and our clients and fund have been superior. And it's been a really good period of time for investors. As investors see the end of high interest rates, but yet not a recession. And so this is really the thing that I think is most different from where people were thinking a year ago, when most people were thinking that a recession was fairly imminent and that was a huge risk with higher rates and such. And as we moved into this year, it became clear that the Fed would not be raising interest rates, and earnings continued to rise. And that's led to a nice rally in the stock market on the anticipation of lower rates. So are lower rates going to happen? And the answer is yes. The CPI, which is the inflation index, along with the PPI, have more than confirmed that inflation has gone down from its extremely high rate back in 2021 and 22 to now a much more normalized rate of inflation, and of the most recent reading, a 2.9% CPI. So what that means is that the cost of living isn't going down. See, I think a lot of people have this misperception that some way prices will go down, but inflation rate is really how fast prices are going up. It's not really whether or not prices will go down. When prices go down, that's usually a very, very bad economic sign. And when we have deflation in our economy, it's usually very bad for stocks and bonds and basically everybody. And so really throughout the history of America, we've seen a constant rate of inflation that's averaged typically between 2 to 3%, and on the long term is averaged close to 3%. So whenever we do assumptions into the future, like for planning your retirement, we assume a 3% inflation rate, and that's the rate that we have today. So with the Federal Reserve holding rates at 5.5%, which are way too high, what that does is it slows the economy because people who want to buy homes, remodel homes, buy cars, buy equipment, start small businesses, and anything that involves lending, as well as consumers and credit cards, have to pay a much higher rate to do things than if rates are lower. So America for 20 years had almost zero interest rates for various reasons. And it started with the financial crisis, and it continued with COVID, and we really never got interest rates normalized since the financial crisis. So over the course of what was 14 years, there was this misperception that rates would never go up. And then with the Inflation Reduction Act and the other bills that were passed that created a lot of inflation, especially in 2021 during the pandemic, what happened was the Fed was forced to raise rates aggressively in 2022 because they were behind the curve in noticing the rapid increase in inflation. And by doing that, they crushed asset values. And we've seen that in the stock market in 22, and now we're seeing it in commercial real estate over the last several years. So the Fed has really changed the paradigm on what expectations are for, let's say, a mortgage or what a savings account will earn. So today you can earn 5% in a money market account, where just 4 or 5 years ago you could earn almost nothing. And so because of that, it takes money out of the economy, it slows the economy, and we've seen those effects in especially the areas that are most affected by interest rates. And so the Fed has now slown the economy. It's the areas like real estate, residential real estate, have almost grind to a halt as buyers and sellers can't come to pricing. And so because lending is so expensive, many businesses are not expanding, and all the other effects that are intended by high interest rates. But those effects aren't needed anymore. And so we expect the Fed to start lowering rates in September and maybe quite rapidly move rates back down to a rate that makes more sense based off where we are with inflation and the economy, which is somewhere below 4%. So there will be hopefully many rate increases over the next 6 months to a year. And that will help consumers and the underlying economy continue to grow as it's slowing now from all the effects of interest rates, and the post-pandemic era enthusiasm has finally waned. People have spent their money. So although we see a stronger economy, it's moving into a slower equilibrium, which is exactly what we want if we're going to have rising markets, rising earnings, and low inflation. And so it's very possible we could create a scenario in the next year that could be highly beneficial for investors. Now, a lot can go wrong. A lot of things can go wrong, and a lot of things can change between now and, let's say, a year from now. And especially geopolitical events like wars can really change the entire outlook. And that's why I don't like to make predictions in general, because there's so many things that can happen that can change. But assuming that the Fed starts to lower interest rates and the economy holds up and we don't have any major economic shocks, the next year or two could be incredibly good for investors. So we're very bullish on the stock market in this current environment, where we see GDP growth at around 2.5% to 3%. We see CPI between 2% and 3%. We see rates coming down. We've seen the 10-year rate move down below 4%. And we've seen stock values move back higher to what we would call a full valuation, especially for large cap stocks. So in general, for our clients and for investors, this is a very good time to be making investments in the stock and bond market. And a balanced portfolio really has the best opportunity to get you the results that you want with less volatility. So we highly recommend having a good balance in your portfolio, and there's a lot of opportunity in stock and the bond market. So it's not just one or the other. So investments in general, including real estate, do better when rates go lower. It's really just simple as that. The value of assets go higher when rates go lower. So the natural rate that the Fed really needs to focus on getting to ultimately is around 3 to 3.5% on the Fed funds rate. And we really don't want to see rates go much lower than that, because that's usually when they have to stimulate the economy. It's usually because something isn't going right. Now, a lot can change. Obviously, we have an election year. So the question is, how will the election affect the economy? And the answer is it won't. One of the things that I'm sure of is that this election between the parties involved is not going to be bad for business. It doesn't really matter who wins, because if Harris wins, we'll have more of the same, and this has been a very good environment for the most part for businesses, and we expect that to continue. If Trump wins, he's very focused on lowering interest rates and on business. Now, many of his other policies, like around trade, are quite regressive and might have negative economic consequences, but we don't expect any of those things to actually pass through Congress. So the truth is that both presidents, potential presidents, are good for the markets. And the first year after an election is usually the strongest year in the cycle. So that's why we're very bullish on 2025, as well as we're still bullish on stocks for the rest of the year. Now, we expect some volatility from now until December because of the election, and we don't expect the election to end on November 3rd when the election is actually held. So we expect there to be a week or two of tremendous uncertainty based off claims of fraud or this or that, but eventually the election will be decided, and hopefully it won't be too long of a period after the actual election. And then once that's cleared out, as we move into 2025, it's typically a very bullish time to own stocks. So that's when the president and Congress has the most mandate to pass the policies that they've been touting, and many of these policies are progressive, if depending on who's president, but also not anti-economic. So I don't expect any big change in taxes. I think that's going to be the big thing, is what happens with the expiring Trump tax breaks. The corporate taxes are fixed in the expiration, so we don't expect anything to change there, but individual tax rates will change, and taxes will go up on wealthy people in red states, but for wealthy people in blue states, if the current law just expires, it would actually be a benefit, because SALT would come back, which are deductions for wealthier people in the blue states. And so actually it would be a tremendous shift in the economic burden of taxes back to wealthy people in the red states from wealthy people in the blue states. So we don't really see any negative with that as well economically. So even though they can say, oh, the taxes are going up on the rich and this and that's going to hurt the economy, the fact of the matter is, in half the country that's not true. Taxes will go down for the wealthy in California and New York, for example. So I actually very, very much hope that SALT comes back and the tax cut expire as they are. It would actually be very beneficial for people in California. So the macroeconomic backdrop is quite positive, and I think that the geopolitical situation with Russia, Iran, Israel, a conflict certainly creates uncertainties that are hard to quantify, especially if there's a regional war in the Middle East. So let's just pray for peace and hope that happens. And if conflict does break out in the Middle East, it will create volatility for sure. But our society doesn't live and die around oil prices like it used to. And certainly if oil prices soar, for example, through a conflict in the Middle East, we don't see that as having a dramatic effect on the U.S. economy, because we are the biggest producer of oil in the world here in the United States, so we don't have to buy it from other people as much. And then secondly, we have so much alternative energy opportunities. So soaring oil prices would actually help EV companies and clean energy companies and further cement the need for alternative energy. So that's about the last thing I think the community that sells oil wants, is more incentive not to use oil. So geopolitical events obviously are something really to consider, because as Russia continues to grind away and lose the Ukrainian war, actions could be taken that might be extreme by Putin. On the other hand, Putin's government might fall and the Russian people might have an opportunity to overthrow this authoritarian regime over the next 6 months as they continue to fail in Ukraine. Not to mention in Iran, the opportunity for the mullahs to get overthrown if this continues going on in Iran and the hardships that the government has caused on their people. So we could see a massively positive shift over the next year in geopolitical events with the enemies of America failing, or we could see a lot of unrest and uncertainty by a continued conflict. So I obviously can't make any reasonable prediction of what crazy dictators are going to do. So we're not going to try, because none of us actually thought, Putin would be dumb enough to invade Ukraine in the first place. But we were wrong about that. So in general, I know that we see a lot of news, and the news is typically scary. So I want to take this moment just to really educate people on why the news seems so scary and why it doesn't serve your needs, especially around business. So one of the things that's a byproduct of the modern economy for media is its pay-per-click. And the more clicks you get on an article, the more you get paid. And it doesn't matter if you're the New York Times or your Facebook. And so everybody's trying to get as many eyeballs and clicks as possible. And so it makes no sense not to run a headline that is an extreme. Now, I work with a YouTuber, this wonderful man named Meet Kevin, and he and I do videos once in a while. And every time he posts one of his videos, it's always confronting Ross Gerber about the economy, and that's what gets people to look at the video, is that there has to be a confrontation, there has to be some extreme viewpoint. The economy is going into a deep recession, or expect Bitcoin to soar to 200,000. Those are the articles that people click on, and that's why you see so much extreme news. And I caution you as an investor to really be careful from letting the news affect your emotions and your belief system when you look around and you're walking around and you're going to the market and you're going to the beach and you're doing all these things and they're packed and people are out spending money, but then you're reading about a recession in the paper and you're wondering why. And it's, once again, it's a pay-per-click industry. And so it's really, really hard to get good information today, which is one of the reasons why I'm doing this podcast again, is because, and I'm not going to do it as much, but is really just to give our clients some fresh viewpoints on the information they're seeing in the news. Because, I think in general, fear sells very well, and the news industry uses fear on a consistent basis to sell. So right now we're in a very good spot in the United States, and you shouldn't be confused. And at the same respect, there's risk out there that higher rates could eventually cause a recession, and that's a reasonable risk. So at this time, I think investors should sit tight, work hard, save, and invest as much money as they can, because we're in a bull market and we just don't know how long it'll last. It could be a year, it could be 5 years. It just depends on policy and many other things. So let's just hope that the bull market continues and we have a clean election and our democracy functions well and we can move into 2025 in a position of strength. Now let's talk about stocks. So in the GK portfolio, we function first and foremost around our biggest sector, which is technology. We've been technology investors. I've been a technology investor since I was a kid. And I was explaining in our investment meeting today why. And the reason is that America is great at technology. It's a wildly profitable business if done right. And if good technology companies are managed correctly, they have very high margins and a lot of scalability for growth that traditional companies just don't have. And part of that is just the leverage of technology as a business. And a perfect example of this is our top holding, NVIDIA. As of now, NVIDIA is the top holding at GK as an individual issue stock. And NVIDIA has been a long-term investment for us going back many, many years, because we are investors in gaming, and NVIDIA is the creator of the best gaming graphics cards. And so we invested in NVIDIA, I would say about 10 years ago, and it's been a phenomenal investment, probably the best investment. I think it is the best investment we've ever made now, because Tesla obviously has underperformed over the last 3 years. So its overall return for our investors has diminished a little bit, but compared to NVIDIA, which is up a substantial amount over that same period of time. So NVIDIA has pivoted. They didn't really pivot. It turns out that their chips work great with autonomy, which we knew from Tesla back in the early days. And then they became great chips for cryptocurrency mining, and that was a great cycle for them. And then it was followed by AI chips. And Jensen Huang, who runs NVIDIA, saw the opportunity in AI chips, and he had increased capacity substantially before the boom. And so he was prepared for this boom when it happened, so that NVIDIA wasn't rushing around trying to build factories to meet demand, which would have really hurt margins. NVIDIA has 70% margins on their chips, and their growth rate is 100% year over year on revenue based off expectations. NVIDIA's valuation is not even crazy considering these crazy good numbers. And NVIDIA is an incredibly shareholder-friendly company, returning lots of capital to shareholders through stock buybacks. So we're very, very bullish on NVIDIA moving forward as a core position. Now, building around AI, we want our clients to have the most opportunity to benefit from this massive trend, investment trend in technology, to build the next level systems to make all the data that we've been collecting for the last 15 years extremely useful. And around this build out, we own several stocks. So within the semiconductor industry, we now own AMD, which is also a semiconductor company that makes regular computer chips, but also GPUs that compete with NVIDIA. Not as good, but still good. And then we own Broadcom, which also has lots of exposure to AI and mobility, and they also make chips and software. And so that gives us exposure to the sort of hardware infrastructure side. And then we have Dell and Supermicro, who are building server systems, and they create the data centers that are being built today by the major tech companies using the hardware that we just recently talked about. And then Dell also sells personal computers. And as we all upgrade our personal computers to AI-enabled computers, Dell will be a big beneficiary of it. So Supermicro and Dell also add to our exposure, and followed by ASML, which is the chip a making company. So they make the machines that make the chips, and their machines are so heavily sought after that the United States literally approves who gets these machines, because we're trying to obviously keep these machines out of the hands of the Chinese so that they cannot gain any competitive advantage on the United States and Europe in AI. ASML makes extremely expensive machines, and they're in massive demand globally, and we expect this demand to continue, especially because of the CHIPS Act here in the United States, and a massive amount of infrastructure spending is being spent on factories in the chip industry. So ASML has a great order book. They'll be busy for some time. Now, then we have Oracle, which manages our databases and also investing heavily in AI. So Oracle would be a company that you could host your AI system with. And then we have our core, what I would call big tech players that will benefit the most from AI, which is Microsoft, obviously the king of AI with OpenAI. And of course, they also own Activision and have a wonderful gaming business and a wonderful business around enterprise. So they're in a great position to implement AI successfully. And then we have Google, which also has a huge opportunity in AI. They're a little behind. They're racing to catch up, but Google knows the most about all of us and about the internet. And if it's implemented correctly with Google, AI has tremendous opportunity as well. And then we have Apple, which is the device maker of the world and sort of the walled garden that protects us and our privacy. And Apple also has huge incentive to implement AI tools onto their phones to create, and computers, to create also a new cycle of upgrades for computers and phones. So that's the second level of AI, is the upgrade of hardware, which is going to happen probably next year sometime, when the AI chips and software converge into making it worthwhile to buy new devices that will be able to do inference or AI on the devices locally, so they won't need the internet. And so the devices need more power, more chips. We're going to a system where there used to be, let's say, 2 chips, main chips in a computer like a CPU and a GPU, to having 3 main chips, which is basically adding a second GPU. They're calling it different things depending on who you talk to, NPU or whatever. But it's basically an AI dedicated GPU, and then a graphics dedicated GPU. And that's why there'll be so much more demand for chips, is essentially we need more chips and more devices, and we need to upgrade all of our server systems. And then we also have to upgrade all of our hardware, desktop, PC, laptops, and phones, to localize AI on your devices. So this is a massive opportunity, and one that investors should not poo-poo. Lastly, on this list, we have Uber, which is another beneficiary of AI and what we consider one of the greatest opportunities in the ride sharing, or what they call the robo-taxi business. We think Uber, with their data, is the best company to implement AI in transportation in a way that will be hugely efficient. And if one day soon or one day later we actually do have robo-taxis, we think Uber and Uber drivers will probably be the best source of these robo-taxis, or managing robo-taxis will be the entrepreneurial drivers of Ubers. So we see Uber as being one of the big purchasers of robo-taxis, and they've, unfortunately for Tesla, cut a deal with BYD. And, quite frankly, I think they have the best data of where riders are and when they want to ride and where they want to go. And if we can use this data correctly, I think there's a tremendous efficiency that Uber can gain in their business, and their business becomes extremely valuable knowing all this transportation data. So although many in the Tesla community are very bullish on Tesla's robo-taxi, the actual system to build robo-taxi, that navigation and transportation system, is something that Tesla's never done and isn't really an expert at. And hence why Tesla isn't partnered with Uber to roll out robo-taxi in the United States is just a mystery to me. That's the way it should work. Is Tesla should be selling robo-taxis to Uber drivers, who will then roll it out on the Uber platform. But right now Tesla wants to do it themselves. And we'll talk about Tesla in a minute, because boy, that's a whole story. So I want to round out technology. These are our investments in technology-related companies that are all AI-related, that are core tech, but also really the entire build-out infrastructure and implementation of AI. We will benefit greatly if this is successful, and these are great companies any way you look at it. So I really, really am very pleased with this technology portfolio that we've built for our clients. Next, climate. Climate is one of the most important things in my life, and one of the things that drive me as an investor for change. And in the past, we've owned many climate investments. And if you go back to the beginning of the fund, we had many climate investments. And it was about 20-something% of the fund. And that caused us to underperform for some time, because climate-related investments have done horrendously poor because of high interest rates. And so despite Biden's desire to boost clean energy, solar, and other areas we were originally invested in, it's actually worked the opposite, because the Fed has raised rates to a degree that it's really damaged solar companies, investments in EVs, and all this kind of stuff. So many of these players that we wish were doing better, we've had to move on from, and sort of accept that this sector is just not as lucrative. But one of the things that happened wonderfully was when I was out at Tesla for Investor Day about 2 years ago. Elon spent a good amount of time talking about heat pumps and air conditioning units and the need for this solution for climate. And I went home that day and said, I got to learn more about air conditioning units and heat pumps, which ironically I was working on with my house anyways. So I told my construction people I want heat pumps put into my house instead of traditional air conditioning units, which I did, and I've been super impressed. So I found Trane Technologies as a company that was making advanced air conditioning systems that were energy efficient, heat pumps are kind of a weird name for them because they pump cold air too. So it's really air conditioning that doesn't have emissions or use natural gas. And this is a huge upgrade, because if you're only using electricity for your energy use, it saves you a lot of money on gas actually. And so especially in winter, when you're burning a pretty decent amount of gas to keep your house warm, you can really save a lot of money using heat pumps, because it only runs on electricity. And the amount, and they work just as good as other air conditioning and heaters. So it's quite a great technology advancement, and Trane has been a great investment for us since Investor Day, and about 100 times better than Tesla's performed since Investor Day. So we're very, very pleased, very grateful that I learned how important this was in solving climate. Now, one of the unfortunate things is Tesla seems to be, despite what probably Tesla wants, to be moving away from being a climate-focused company to trying to be an AI-focused company. So maybe Tesla doesn't even deserve to be in the climate, section of our portfolio, and it should really just be in the technology section, because Elon has basically decided that he doesn't want to sell EVs and save the earth anymore, as he wants to create robo-taxis and AI solutions that he figures is going to be much better for Tesla on the long term. So robotics and AI is definitely an investment worth paying attention to, but it's vastly different from the investment thesis that we originally invested in Tesla. And I think there's a lot of confusion on my view about Tesla, because I don't think people fully understand this transition and the implications of moving away from business that sells cars with great safety features that drive themselves, that are great for the environment, to building vehicles that are for taxis and selling them to people so that they don't drive, and building robots, which is a completely untested industry, and certainly putting robots in people's houses has yet to happen even anywhere close. So, as I like to say, I'm not here to say that anybody's vision of the future is wrong or right, because we just don't know. And Elon has a vision of the future that he is now applying to Tesla that's vastly different than the original investment thesis that we invested in Tesla, which was really about selling more vehicles and selling more services and software on those vehicles. And then if customers wanted to turn these into taxis, they could. But I don't think people want to do that. And so one thing that I'm sure of is that people don't want random people in their car. So it's a certain type of person that wants to do robo-taxis, and they're the people who do Turo or Uber today. And so there is a market for robo-taxis, but it's being served by Uber right now with humans. But does the market expand because there's more robo-taxis? Do humans change their desire to control where they drive every day and when they get their car? And I just don't think so. One thing I'm sure of is how hard it is to get humans to change. Getting humans to change their habits is extremely hard. And Elon's tried many times to get us to do this. And a perfect example is when you get in or out of a Tesla. What they did was they moved the handle from where your hand is to where your thumb is. Now, if you want to see people struggle who don't drive a Tesla, is watch them try to get out of your car. And they can't figure out how to get out, because he changed it from using your fingers to open the door to using your thumb at the top. And it's a fine change, but it takes a while to relearn how to do this, okay? And just like he built a Cybertruck with a rear view mirror that doesn't work. I can't tell you how difficult it is to change looking at a rear view mirror that's blank all the time and then having to look down at the screen where my rear view mirror is now. It's a simple thing. I'm not saying it's bad, but my body wants to look at the rear view mirror and it's blank every time. Why they didn't put the video in the rear view mirror, I don't know. But it's a serious design flaw that you can't use a rear view mirror in a Cybertruck, but it has one. So Elon's like, oh, you'll just look at the screen when you want to see what's behind you. But it's not that simple, because you've trained yourself over 35 years or 40 years of driving to look at a rearview mirror. So humans are really stuck on these things, and this is going to be the real big problem with trying to change human behavior by creating a robo-taxi, where I think there's some assumption that there's going to be some sort of bigger market for taxis than already exists today. And I just don't think people are going to give up their cars. I think people want to drive their cars. And then they said, well, when you're at work, don't you want your car driving around making money? And I'm like, from who? Everybody else is also at work. Who's driving around in the middle of the day? It's actually the only time in LA you can get around is the middle of the day. It's the only time. Why? Because nobody's using their cars. Everybody uses their cars at the same freaking time. I don't know if you've noticed this, okay? It's called traffic. Everybody uses their cars at the same freaking time. How are we going to change that? Oh, well, we have work from home. Is the traffic on? No. Well, why? Well, because people are still driving around at the same time, okay? So this is the risk that has now moved into Tesla, is as we've moved away from selling great cars to people to robo-taxis, we don't even know what that market looks like and whether it's profitable or whether people want it, and it's a complete unknown. And robots, boy, I asked 5 people if they would put a robot built by Elon Musk in their house, and all 5 said there's not a chance in the world. Not a chance in the world was the answer. Nobody trusts Elon Musk to put a robot in their house today. And that's just the reality. So I don't want to go into the politics of Elon and all this kind of stuff. I think the reality is people don't trust putting HomePods in their house that are listening to us. The last thing I need is some robot sneaking around my house spying on me for Elon. Okay? So I don't know what the market is for robots in a house, consumer robots. I know what the market is for robots, let's say doing mining jobs or like dangerous jobs at the airport, like working on planes or something like that. But that's not a massive market. And there already are robots doing this. Like, I don't know if you know this, but there's robots working at the Amazon factory right now. You know, there's robots working at the Tesla factory. There's no shortage of robots being made today. So the question is, will consumers buy a robot for $30,000 from Elon and put it in their house? I don't know. And I don't know when that's going to happen. So how do we quantify this robo-taxi? And how do we quantify this robot in the future earnings of Tesla? And there's just no way. Okay. So then we go back to vehicle sales. Well, vehicle sales can't grow now because they won't advertise. So the only advertising that Elon does is bad for Tesla. Okay. And that's supporting Donald Trump. Now, I'm not going to tell you my opinion about Donald Trump or this or that because this isn't about politics. But Donald Trump doesn't support electric vehicles. So Elon might spend $160 million to try to buy that support from Donald Trump. But what Elon will learn is that Donald Trump doesn't care once he gets elected, if he gets elected, anything about EVs or Elon. He only cares about himself. So I don't know if Elon's figured this out, but he would be very detrimental to Tesla by removing the tax benefits that Tesla owners get when they buy a Tesla and the company gets through these regulatory credits, which total billions of dollars. So Tesla's in a weird spot because I'm kind of confused on how they're going to sell more vehicles without advertising. And unfortunately, as an owner of a Cybertruck, one of the things I've realized is that the vehicle doesn't serve many purposes. It's a fun vehicle and I love it and I like it. But I'm trying to figure out why anybody wants or needs a Cybertruck. Okay? Because you can buy a Ford F-150 Lightning for half the price and it's a truck. And you can buy a Rivian that's also a truck and you don't have to feel like you're buying a MAGA truck. And so, you know, I think the sad reality is that the Cybertruck will be just limited in what its sales ability will be. And I don't know if they can sell 250,000 Cybertrucks a year. And right now, I we'll have to see. You know, so it's easy to launch a Cybertruck and say, we're the number one luxury truck. Well, you know how many luxury trucks you're comparing to? Who the heck has $100,000 for a truck other than people like me? So I'm driving this thing going, who's the market for this truck? It's just people like me, I guess. And sure enough, there's 4 or 5 in the Palisades, you know, and then I'm thinking, you know, the regular guys, you know, drive pickup trucks every day, you know, they just can't afford a Cybertruck. So that's just what it is. So Cybertruck prices will come down. Don't get me wrong, but will that also crush margins? So, you know, Tesla's got a lot of uncertainty. That's just reality. We lowered the position that we own in Tesla for various reasons. But mostly we see the future to be very cloudy despite having tremendous opportunity. Now we can talk about energy storage and all the great things about Tesla, and I love the vehicles and all the great things about Tesla, but it just doesn't matter when the company is basically an afterthought to the founder and CEO. So that's Tesla. Next. So we own consumer stocks, but this is really based around the two themes, things that used to be illegal and streaming, sports, and entertainment. So let's start with streaming, sports, and entertainment. So we have Netflix and Disney, and Netflix being a high flyer winner, huge success story, now getting into sports and really dominating the streaming business. But really Disney as a value turnaround play, we really, really like this business right now. Iger's lined up a great movie slate over the next 2 years. ESPN's business is getting itself worked out and they come off these cable contracts this next year so they can really expand the streamer. And then you've got Hulu and Disney Plus really starting to become profitable and raising prices again so that they'll be solidly profitable. So when you actually look at Disney, there's some concern about the theme parks, but that's mostly because prices are high and they've been so busy post-COVID, and now it's normalizing. But that's okay. People aren't giving up going to Disneyland, and they're investing a ton of money in new rides and experiences for people, and people want to go. It's just what people do. So maybe the business won't grow as much, parks and resorts, as it did post-COVID, but it's a highly profitable, lucrative business. But the area of the business that people seem to just be ignoring is the streamer. And so, what is the value of Hulu and ESPN Plus and ESPN sports business, and then Disney Plus, and how does that all work itself out? And with Netflix valued at $260 billion and Disney valued at $160 billion, with all these other things, we just find Disney to be a compelling value today. And then we have things that used to be illegal, which are cannabis, which everybody's talking about legalization and rescheduling. We're seeing better numbers out of the cannabis companies. We saw a nice rally, and now we'll pull back. We just need some definitive policy on legalization so that the owners of the businesses can have more certainty. And then the rescheduling will also help with taxes. So we have about a 2% position in cannabis companies, and we're still wildly bullish on this industry long term. But we've just got to get through this political morass that's now been 4 years in the making, which sucks. And then we have MGM Grand, which is just absurdly cheap. Also have online gambling business that's about to be profitable. It's kind of borderline profitable. It's a super competitive business, but their Vegas business is great. There was some consternation because Formula One and the Super Bowl, it was the first Formula One in Vegas, and then it was like the first Super Bowl in Vegas, and that's not happening again. It's the second Formula One coming in November, and then there's obviously the Super Bowl moves to New Orleans. So there's some comps that are pretty much impossible to beat over the next 6 months, but that's just because they were so good. But they have other levers that people are not paying attention to, which is their convention business and their business with Marriott, which is really, really helping fill rooms and at higher and higher prices. And the average spend by these customers is higher than the ones that they're replacing. And this is just getting going for MGM. So MGM's trading absurdly cheap. And as we move into the next several years with the online business getting profitable and the continued desire for people to have fun, go to Vegas, gamble, regional gambling facilities, and then their business in China has come back. So we are very bullish on these companies and the valuations in cannabis, in MGM and Disney in particular are quite compelling. So next we have what we call top consumer brands, and we've made some changes here over the last couple months, and we moved out of the Nike and the Lulus to On Holdings and Crocs. I loved the shoe business, and On Holdings is one of the more innovative and interesting shoe companies to come out, really compete against companies like Nike. We also have Deckers, which we don't own, but Deckers Hoka shoes have also made a lot of inroads against Nike. Basically, Nike's let their business languish, and companies, whether it's in clothing like Lulu or in shoes like On and Hoka, have really whittled away Nike's business, and On continues to grow with nice margins. Crocs is actually an extremely popular brand among kids, and actually I love my Crocs as well. Very high margin. The only downside to Crocs is they have this Hey Dude brand that's been declining, and the valuation's extremely cheap because of this Hey Dude brand, and they need to stabilize or sell Hey Dude. But the Crocs core business is extremely profitable and lucrative. We're watching this position because we want them to make some moves to stabilize their growth. Then we've got Amazon, which we've been adding to. It's a consumer brand, but it's really also about sports, entertainment, advertising, AI. Amazon under Andrew Jassy is way more interesting to me than under Bezos or the end of Bezos. Jassy's been making, I think, a lot of the right moves, but Amazon now has the NBA package and an NFL package, and they're selling ads that are extremely effective for their brands because people can go right from the Amazon, viewing, website, Amazon Prime Video, and buy things right off the site. So if you're an advertiser, it's a pretty compelling package to be able to advertise on, their streaming platform and then also on their e-commerce platform. And these synergies make Amazon a very compelling place for advertisers, and that's really what's growing very quickly. On top of the fact AWS has a lot of opportunity. They've got a ton of data on everything that's going on with consumers. So Amazon, I think, is actually at the lowest valuation I've seen Amazon in a long time, and we like it here. And then Home Depot, which has not had exciting sales for some time because of interest rates, got a nice boost recently after earnings because they continue to run a very well-disciplined business, and one that we've owned for a very long time and will continue to own, because as rates go down, the home remodeling will come back and the equity lines will cause people to, upgrade their houses. Many younger people are kind of stuck in their houses with low interest rates, and with lower equity line rates will then spend money to remodel and fix their houses. And in like a lot of areas like mine in here in LA, if you want to buy a house, most of the time you're buying a very old house and you have to fix it because all the new houses are too expensive. So I think with rates going down, Home Depot will be a big beneficiary over the next several years. Next, we have our Beyond section, and this is broken into a couple subsections, starting with financials, which we have LPL Financial, which is our custodian, and full disclosure, one of our custodians. It's a wonderful company with great management that's really dominating the RIA space. And then we have Blackstone, which is a financial company that owns, private equity and real estate. We participate as owners in their fees, and that's sort of the benefit. As their assets grow and become more valuable and they're able to monetize those assets, their investors will do very well. So we expect Blackstone to have a good period of time over the next couple of years. And they also have had some opportunities to buy distressed assets and really work their portfolio over the last couple of years that have been quite difficult for Blackstone. And, one thing I've learned about this team is, boy, they always come out on top every cycle. So this is a great time to look at Blackstone. The stocks move back up. Lennar, which is one of my favorite companies because there's such a huge demand for homes that it's just like unending, as many homes as they can build. And the big struggle has been, it's been affordability of homes because rates are so high. So if rates are 7% versus 3%, and you're trying to buy $1 million home, it just becomes unaffordable to have to pay $40,000 a year more to buy the same home for a typical family. It's just not possible. So Lennar's had to subsidize interest rates and do other things to help people get into their homes, and that will be alleviated, giving them better margins without losing any demand. So lower rates will be hugely beneficial for real estate companies, including VICI properties or Vici properties, which basically we own all the casinos in Vegas and regionally. We also own Bolero, the land under Bolero, and also Canyon Ranch. VICI Properties continues to expand. We collect rent here. It pays currently about 5.25% yield. It's moved back up now that rates are going down, and we expect this to be a compelling investment over time for income investors. And it's just a solid way to get income and some growth and really own some wonderful assets. So that's VICI Properties. So that's our financial and our real estate exposure. I do count Home Depot and real estate a little bit too. And then also we own some Bitcoin in the fund. We own about 2% of the fund in Bitcoin. We've acquired those shares around the same prices where it's trading today. So the low $60,000 range. I'm very bullish on Bitcoin long term. It's sort of a place where I'm keeping extra cash instead of in cash. Because I think Bitcoin is more compelling than just holding cash. So we own some cash in the portfolio, and then we own some Bitcoin as cash in the portfolio. People go, oh, it's too volatile to be cash and this or that. But, it's been around the same price, for a while. But if you, think about the long-term opportunity in Bitcoin, I'm very, very bullish in this opportunity. And then last, we have healthcare. I'm a big believer in the aging of our population is a humongous opportunity. Originally, we really got involved with GLP-1 drugs and bought stock in Novo based off Ozempic and Wegovy. And every day we seem to learn more and more of the benefits of these GLP-1 drugs and helping people lose weight. This is a huge thing for our society because we have a huge amount of obese people. 40% of our society is obese or overweight. And it turns out there's lots of benefits to taking GLP-1 drugs. There's some negative side effects as well. But when you actually look at all the benefits of losing weight, on top of some of the things they're learning about addiction and other side benefits they found. We expect these drugs to be incredibly popular for a long, long time, if not forever. And so Novo and Lilly are the two players here, but really Novo is a pure play and much cheaper stock to own than Lilly. And then we have Regeneron, which really mostly a lot of their growth is around their eye treatments and such, which is obviously macular degeneration and other things are a huge issue for older people. I'm very bullish on Regeneron. What a great company, great innovation. And then Zoetis, which is our animal health company. It used to be a separate thing. We used to invest in like the pet industry and animals, but we sort of got out of that with the consumer. But we still own the pharmaceuticals for the pet industry through Zoetis. It's a small position for us, but it's been an excellent company over time. So I think that's all of our stock holdings that we own today. I recently added a new company, which I'm not going to talk about yet. But you'll probably see in the next week or two. Some of our newest, additions are stocks like On and Crocs as well. So we are constantly looking for opportunities in the markets, despite the challenge when markets are higher. And at the same time, we very, very much are confident about our core holdings. Our performance has improved greatly over the last year and certainly year to date and over 2 years as well. So really our worst period of time was we started at a very difficult time in the sort of middle of 21, which led into our first fiscal year from 21 to middle of 22 was extremely difficult period of time. But from mid 22 to today, our results have been much better and I think will continue to improve as the bull market continues. So we sort of started with a bear market and now we're in our second year of the bull market pretty much. And, our returns have improved dramatically in that period of time. You can look those up on the internet if you'd like. But we're very, very bullish about the future and our holdings and the way we're positioned to take advantage of the future. And that's, I think, one of the most compelling reasons to work with our firm. Build your financial plan. Work with one of our top advisors. We have great advisors at our firm who are super conscientious, constantly learning and working to help our clients reach their financial goals. And so that's really the point of our investment management, is really to add value beyond just building a financial plan, but really helping you better manage your money for the opportunities we see as investors. And over time, these opportunities have paid off nicely for our clients. And, I think that's really our most important message today is patience. And that's why we started with the song, is sometimes it takes a little bit of time for themes to play out and investments to play out. And if you have patience, the markets pay off over time. So we appreciate your patience. It's been a good 12-month period of time for investors, and we expect and hope for another good 12-month period of time for investors. So that's the mid-year review for GK clients and fund holders. And I hope if you have any questions, please email us your questions or make comments. We're looking to try to answer your questions today and make your financial situation or improve your financial situation. So our main goal as a firm is to really see our clients benefit from our hard work and their hard work and saving, investing your money so that you can reach your financial goals. So that's the GK fund overview, and have a wonderful day. And now we will go into Let's Talk Money.
Said woman, take it